Let me tell you about a conversation I had with a man who changed how I think about wealth preservation forever. He was 62 years old, retired from a successful career in engineering. He had accumulated nearly $2 million over 40 years of disciplined saving and investing. He had done everything right, maxed out his 401k every year, avoided debt, lived below his means, built a portfolio that should have provided security for the rest of his life. And then 2008 happened. He came to me in early 2009, after the worst of the crash. His portfolio had dropped from $2 million to $800,000. 60% of his life savings gone in less than 18 months. He was devastated, not just financially, but psychologically. He could not sleep, he could not eat. His marriage was strained. He told me he felt like 40 years of his life had been erased. But here is the part that really stuck with me. He had not even sold at the bottom. He had held on. He had done what all the financial advisors tell you to do. Stay the course. Do not panic. Ride it out. And he still lost 60% of his wealth in a matter of months. Now, his portfolio eventually recovered by 2013 or so. He was back to where he started. But those 4 years of watching his wealth evaporate and then slowly rebuild, those years took something from him that he never got back. He told me the experience aged him a decade. He spent what should have been the best years of his early retirement living in fear, second-guessing every decision, unable to enjoy the wealth he had worked so hard to accumulate. That conversation haunts me because it illustrates something that most financial advice completely ignores. When you are over 55, you cannot afford to lose 60% of your wealth, even temporarily. You do not have the time to recover. You do not have the earning years left to rebuild. And the psychological toll of watching your life savings evaporate can be just as destructive as the financial toll. This is why wealth preservation is fundamentally different from wealth accumulation. When you are 30, volatility is your friend. You buy more shares when prices are low. You have decades for compound interest to work. A 50% crash is an opportunity, not a catastrophe. But when you are 55 or 60 or 65, everything changes. You are no longer accumulating, you are preserving. You are not trying to maximize returns. You are trying to minimize the probability of catastrophic loss. The math is completely different. The psychology is completely different. And most people never make that mental shift until it is too late. Today I am going to share exactly how I would approach wealth preservation if I were over 55 and had accumulated meaningful savings that I could not afford to lose. This is not the approach that will generate the highest returns. This is the approach that will let you sleep at night knowing your wealth is protected against the kinds of catastrophic events that destroy unprepared portfolios. Let me start with the most important principle, which is understanding what you are actually protecting against. Most people think about market risk when they think about wealth preservation. They worry about the stock market crashing, and yes, that is a real risk. But it is not the only risk. And in some ways, it is not even the most dangerous risk. Let me walk you through the complete taxonomy of risks that can destroy wealth for someone over 55. The first risk is market risk. This is the obvious one. Stocks go down, bonds go down, real estate goes down. Whatever assets you own decline in value. This is what happened in 2008. It is what happened in 2000. It is what happened in 2020. Although that crash was so brief most people barely noticed. Market risk is real, but it is also the risk that most people over-prepare for. They see a crash coming and they sell everything and move to cash. Then the market recovers and they miss the rebound. Or they stay invested, and the crash is worse than they expected, and they panic sell at the bottom. Either way, trying to time market risk usually makes things worse rather than better. The second risk is inflation risk. This is the silent killer that most people completely ignore. Inflation does not feel like a crisis. Your account balance does not go down. But the purchasing power of that balance erodes year after year until what seemed like a comfortable nest egg can no longer support your lifestyle. Consider this. If inflation averages 4% per year, which is higher than the historical average but lower than what we experienced in 2021 and 2022, the purchasing power of your money is cut in half in about 18 years. If you retire at 60 with $1 million, by the time you are 78, that $1 million buys what 500,000 bought when you retired. If you live to 85 or 90, you could be trying to survive on a quarter of the purchasing power you started with. This is why sitting in cash is not safe. Cash feels safe. Your balance does not fluctuate, but you are being robbed slowly by inflation while you watch. The theft is just invisible. The third risk is sequence of returns risk. This is the one that almost nobody understands, but that destroys more retirements than any other single factor. Sequence of returns risk means that the order in which you experience gains and losses matters enormously when you are withdrawing from your portfolio. Two investors can have identical average returns over 20 years, but completely different outcomes depending on when the bad years occur. Let me give you a concrete example. Imagine two retirees, both starting with $1 million, both withdrawing $50,000 per year, both experiencing average returns of 7% over 20 years. But for retiree A, the bad years come early. The market crashes in years 1 through 3, then recovers for retiree B. The bad years come late. The market does well for 17 years, then crashes in years 18 through 20. Retiree A runs out of money in year 15. Retiree B dies with over $2 million. Same average return, completely different outcomes. The only difference is the sequence in which those returns occurred. This is why the first 5 to 10 years of retirement are so critical. If you experience a major crash early in retirement while you are withdrawing funds, you may never recover. You are selling shares at depressed prices to fund your withdrawals, which means you have fewer shares to participate in the eventual recovery. The math works against you in a way that cannot be overcome. The fourth risk is longevity risk. This is the risk that you live longer than your money lasts, and it is a bigger risk than most people realize. If you are 55 years old today and in reasonable health, there is a meaningful probability you will live to 90 or beyond. That is 35 years of retirement, 35 years of inflation, 35 years of market volatility, 35 years of healthcare costs that increase faster than general inflation, 35 years of potential cognitive decline that could impair your ability to manage your own finances. Most people dramatically underestimate how long they will live and therefore dramatically underestimate how much money they need. They plan for 20 years of retirement and end up needing 30. They run out of money at 85 and spend their final years in poverty. The fifth risk is healthcare risk. This is specific to the United States, but it is enormous. A serious illness can cost hundreds of thousands of dollars, even with insurance. Long-term care can cost $10,000 per month or more. And Medicare, while helpful, does not cover everything. I have seen families with multi-million-dollar portfolios bankrupted by healthcare costs, a stroke that requires years of rehabilitation, a dementia diagnosis that requires round-the-clock care, a cancer treatment that insurance will not fully cover. These events can burn through savings faster than any market crash. The sixth risk is behavioral risk. This is the risk that you make bad decisions under stress, that you panic sell at the bottom, that you chase performance and buy at the top, that you fall for a scam or make an investment you do not understand, that you trust the wrong advisor or the wrong family member with your money. Behavioral risk is insidious because it feels like you are making rational decisions in the moment. Selling everything after the market drops 30% feels like the prudent conservative thing to do. Buying that hot stock your nephew recommended feels like a reasonable way to boost returns. But these decisions, made under emotional stress or social pressure, are often catastrophically wrong. Now that you understand the full landscape of risks, let me tell you how I would structure a portfolio to defend against all of them simultaneously. The core principle is what I call layered defense. You do not try to optimize for any single risk. You build multiple layers of protection so that even if one layer fails, the others keep you safe. Layer 1 is what I call the liquidity fortress. This is cash and cash equivalents, sufficient to cover 2 to 3 years of living expenses. For most people over 55, this means somewhere between $100,000 and $300,000 in money market funds, short-term treasury bills, or high-yield savings accounts. This liquidity fortress serves multiple purposes. First, it protects against sequence of returns risk. If the market crashes in your first few years of retirement, you draw from the liquidity fortress instead of selling stocks at depressed prices. This gives your equity portfolio time to recover without being decimated by withdrawals. Second, it protects against behavioral risk. When you have 2 or 3 years of expenses sitting in cash, you are psychologically less likely to panic during a market crash. You know you can survive for years without touching your investments. That security makes it easier to stay rational when everyone else is panicking. Third, it provides flexibility for opportunities. If the market crashes and great companies are suddenly available at bargain prices, your liquidity fortress gives you the ability to buy when others are forced to sell. Now, I know what you are thinking. Holding $200,000 in cash is expensive. You are earning 4 or 5% when you could be earning 10% in stocks. That is true. But the insurance value of that cash, the protection it provides against sequence of returns risk and behavioral risk, is worth far more than the foregone returns. This is not dead money. This is insurance layer. 2 is the income foundation. This is the portion of your portfolio dedicated to generating reliable, growing income regardless of what stock prices do. I would allocate approximately 40% of a retirement portfolio to this layer. The income foundation consists primarily of dividend-paying stocks with long track records of dividend growth. I am talking about companies that have increased their dividends every year for 25, 50, even 60 consecutive years. Companies like the ones that kept paying and raising dividends through the 2008 financial crisis, through the dot-com crash, through every recession and market disruption of the past half-century. These companies are not exciting. They are not going to double in a year, but they provide something far more valuable for someone over 55, which is reliability. The dividend checks arrive every quarter, regardless of what the stock price does. And those dividends grow over time, providing a natural hedge against inflation. A portfolio of dividend aristocrats currently yields about 3 to 3.5%. On $500,000, that is $15,000 to $17,500 per year in dividend income. But because these companies raise their dividends 5 to 10% annually, that income grows over time in 10 years. You might be receiving $25,000 to $30,000 per year from the same portfolio. In 20 years, $40,000 to $50,000, your income keeps pace with inflation, and then some. The psychological benefit of dividend investing cannot be overstated. When the market crashes, when your portfolio value drops 30 or 40%, the dividend checks keep coming. This provides psychological stability that prevents panic selling. You are not dependent on selling shares to fund your lifestyle. You live off the income and let the share prices recover in their own time. Layer 3 is the growth reserve. This is the portion of your portfolio dedicated to long-term capital appreciation. I would allocate approximately 30% to this layer. The growth reserve is invested in broad market index funds, primarily the S&P 500. This provides exposure to the long-term growth of the American economy without the risks of individual stock selection. Now, you might wonder why someone over 55 needs any growth at all. The answer is longevity risk. If you might live 35 more years, you need your portfolio to at least keep pace with inflation over that period. A portfolio that is 100% income focused will lose purchasing power over time. The growth reserve provides the appreciation needed to maintain purchasing power over a multi-decade retirement. The key is that you do not touch the growth reserve for current expenses. You live off the liquidity fortress and the income foundation. The growth reserve sits and compounds in the background, providing the fuel for the later years of retirement when inflation has eroded the purchasing power of everything else. Layer 4 is the chaos hedge. This is the portion of your portfolio dedicated to assets that perform well when everything else is falling apart. I would allocate approximately 10% to this layer. The chaos hedge includes treasury bonds, particularly treasury inflation-protected securities or TIPS. It includes some allocation to gold, not because gold is a great investment in normal times, but because it tends to hold value during currency crises and extreme market stress. It might include a small allocation to other real assets that provide inflation protection. The purpose of the chaos hedge is not to generate returns in normal times. It is to provide a ballast when everything else is crashing. In 2008, while stocks were falling 50%, treasury bonds rose significantly. In 2020, the same pattern repeated. The chaos hedge provides assets you can sell at elevated prices during a crisis if you need additional liquidity. Now let me talk about how these layers work together in practice. In a normal year, you draw your living expenses from the dividends generated by the income foundation, plus any interest earned on the liquidity fortress. You do not touch the growth reserve or the chaos hedge. The growth reserve compounds. The chaos hedge provides insurance. If the market crashes, you stop drawing from the income foundation and instead draw from the liquidity fortress. You do not sell any stocks at depressed prices. You live off cash while waiting for recovery. If the crash is severe and prolonged, you might sell some of the chaos hedge, which has likely appreciated during the crisis, to replenish the liquidity fortress. If inflation spikes, your dividend income grows along with it because dividend aristocrats raise their payouts. Your tips in the chaos hedge also adjust upward with inflation. Your growth reserve benefits from the higher nominal earnings that inflation produces. You are protected from multiple angles. If you live longer than expected, the growth reserve that has been compounding untouched for 20 years provides the additional capital you need for your 80s and 90s. You are not dependent on a fixed pool of money that gets depleted over time. This is what layered defense looks like. No single asset class provides complete protection, but together they create a system that is resilient against market crashes, inflation, sequence of returns risk, and longevity risk simultaneously. Let me now talk about some specific implementation details that can make a significant difference. First, tax location matters enormously. If you have both taxable accounts and tax-advantaged accounts like IRAs and 401ks, you should be strategic about which assets go where. Generally, your dividend stock should go in tax-advantaged accounts, where the dividends are not taxed annually. Your growth stocks should go in Roth accounts, where all future gains are tax-free. Your most tax-efficient assets, like broad market index funds with low turnover, should go in taxable accounts. This is called asset location, and it can add 0.5% or more to your annual returns without taking any additional risk. Over a 30-year retirement, that adds up to hundreds of thousands of dollars second. Withdrawal sequencing matters. In general, you want to withdraw from taxable accounts first, then traditional IRAs, then Roth accounts last. This allows the tax-advantaged accounts to continue growing tax-free as long as possible. But there are exceptions. If you are in an unusually low tax bracket in a particular year, it might make sense to do Roth conversions, moving money from a traditional IRA to a Roth and paying taxes now at a low rate rather than later at a potentially higher rate. This requires careful analysis but can save substantial money over time. Third, rebalancing discipline matters over time. The different layers of your portfolio will grow at different rates. The growth reserve might outperform and become too large a percentage of your portfolio, or it might underperform and become too small. Either way, you need to periodically rebalance back to your target allocations. Rebalancing is psychologically difficult because it requires you to sell what has done well and buy what has done poorly. But this discipline is essential for maintaining the layered defense. If you let your portfolio drift, you might end up with far more risk than you intended when the next crisis hits. Fourth, expense minimization matters. Every dollar you pay in fees is a dollar that does not compound in your portfolio. Over 30 years, even small fees add up to enormous amounts. Use low-cost index funds for your growth reserve. Use commission-free brokerage accounts. Avoid expensive, actively managed funds that charge 1 or 2% annually and usually underperform their benchmarks anyway. Avoid expensive annuity products with hidden fees and surrender charges. Avoid financial advisors who charge a percentage of assets when a fee-only advisor would provide the same advice for much less. The difference between paying 0.5% annually and paying 1.5% annually is over $500,000 on a $1 million portfolio over 30 years. That is real money that should be in your pocket, not in your advisor's pocket. Let me also address some common mistakes I see people over 55 make with their wealth preservation strategies. The first mistake is being too conservative too early. Some people hit 55 and immediately move everything to bonds and cash. They reason that they cannot afford to lose money. So they should avoid all risk, but being too conservative creates its own risks. A portfolio that is 100% bonds will not keep pace with inflation over 30 years. You will slowly become poorer in real terms even as your nominal balance stays flat. And bonds have their own risks, as anyone who owned long-term bonds in 2022 discovered when they lost 20 to 30% of their value as interest rates rose. The layered defense I described maintains significant equity exposure even in retirement, because equities are the only asset class that reliably outpaces inflation over long periods. The key is structuring that equity exposure in a way that provides income and psychological stability rather than just raw growth. The second mistake is being too aggressive too late. The opposite problem is people who keep a young person's portfolio into their 60s and 70s because they cannot stand the idea of lower returns. They have 80 or 90% in stocks because that is what worked during their accumulation years. These people are playing with fire when the next major crash happens, and it will happen. They will lose 40 or 50% of their wealth at precisely the moment when they cannot afford to lose anything. And if that crash happens early in their retirement, sequence of returns risk could destroy them permanently. The right approach is somewhere in between, significant equity exposure, but structured defensively. Growth potential, but with income and stability as the primary goals. The third mistake is failing to plan for healthcare costs. Too many people assume Medicare will cover everything. It will not. Medicare does not cover long-term care. It does not cover dental or vision. It does not cover many prescription drugs without supplemental coverage. The gaps can be enormous. You need either long-term care insurance, which is expensive but can be valuable for the right person, or a dedicated pool of assets specifically earmarked for potential healthcare costs. Failing to plan for healthcare is one of the most common ways that seemingly secure retirements become financial disasters. The fourth mistake is failing to plan for cognitive decline. This is uncomfortable to think about, but cognitive decline is a reality for many people as they age. And when your ability to manage your own finances deteriorates, you become vulnerable to exploitation, to bad decisions, to well-meaning family members who do not understand your situation. You need a plan for what happens if you can no longer manage your own money. This might include setting up a trust, establishing durable power of attorney with someone you trust, creating instructions for how your assets should be managed if you become incapacitated, and discussing your wishes with family members while you are still fully capable. The fifth mistake is failing to account for your spouse. If you are married, wealth preservation is not just about you. It is about ensuring your spouse is protected if you die first. This means understanding how your pension and Social Security benefits change upon your death. It means ensuring your spouse knows where all the accounts are and how to access them. It means titling assets correctly so they transfer smoothly. It means having adequate life insurance if your death would create a financial hardship. I have seen too many cases where one spouse handled all the finances, died unexpectedly, and left the surviving spouse confused and vulnerable. Do not let this happen to your family. Let me close with some thoughts on the psychological dimension of wealth preservation. When you are over 55 with significant savings, your relationship with money changes. Money is no longer just a number. It represents your life's work. It represents security for you and your spouse. It represents potential inheritance for your children. It represents freedom and independence and dignity in your final years. Losing that money is not just a financial event. It is an emotional catastrophe. I have seen people who lost significant wealth in market crashes never recover psychologically. They spent their remaining years consumed by regret and fear, unable to enjoy whatever they had left. This is why wealth preservation is not just about maximizing expected returns. It is about minimizing the probability of catastrophic outcomes. It is about structuring your finances so that no single event, no matter how severe, can destroy everything you have built. The layered defense I have described is designed with this principle in mind. Any single layer can fail, and you will still be okay. The market can crash and your liquidity fortress protects you. Inflation can spike and your dividend growth and tips protect you. You can live longer than expected and your growth reserve provides for your later years. Healthcare costs can explode and you have resources to draw upon. No strategy is perfect. No strategy eliminates all risk, but a well-designed wealth preservation strategy can reduce the probability of catastrophic loss to the point where you can live your remaining years in peace rather than in fear. That is what I want for everyone over 55 who has worked hard and saved diligently and deserves security in their final decades. Not maximum returns, not beating the market, just the knowledge that your wealth is protected, that you will not run out of money, and that you can enjoy the years you have left without financial anxiety. Build your layered defense. Protect your liquidity fortress, nurture your income foundation, let your growth reserve compound, maintain your chaos hedge, and then stop worrying and start living. Your wealth is meant to serve you, not the other way around. Preserve it wisely, and it will take care of you for the rest of your life. Now, let me share some additional insights that I think are critical for anyone over 55 thinking about wealth preservation in today's environment. The current moment presents some unique challenges that did not exist even a decade ago. Interest rates, after being near zero for over a decade, have risen dramatically. This is both good and bad for wealth preservation. The good news is that your liquidity fortress can now earn meaningful returns. Money market funds are paying 4 or 5%. Short-term treasury bills are paying similar rates. You are no longer being penalized for holding cash. This makes the layered defense strategy more attractive than it was in the zero interest rate era. The bad news is that rising rates have created losses in bond portfolios that many people did not anticipate. The traditional advice for retirees was to hold a significant allocation to bonds because bonds were safe. But in 2022, long-term treasury bonds lost more than 20% of their value. Investment-grade corporate bonds lost similar amounts. The supposedly safe portion of people's portfolios turned out to be not safe at all. This is why I emphasize short duration in the liquidity fortress. Treasury bills that mature in 3 months or 6 months or a year have virtually no interest rate risk. If rates rise, your bills mature and you reinvest at the higher rate. You are not locked into a long-term bond that loses value as rates rise. For the chaos hedge, I prefer Treasury inflation-protected securities known as TIPS. Over traditional bonds, TIPS adjust their principal value with inflation, providing protection against both deflation and inflation. They are more volatile than regular Treasury bonds in the short term, but they provide better protection against the specific risks that matter most for retirees. Let me also talk about Social Security, because this is a critical piece of the wealth preservation puzzle that many people get wrong. If you are 55 today, you are still a decade away from being able to claim Social Security at the earliest age of 62. But the decisions you make about when to claim Social Security can have an enormous impact on your total lifetime wealth. The basic math is this. You can claim Social Security as early as 62. But your benefit is permanently reduced by about 30% compared to waiting until your full retirement age of 67. If you wait until 70, your benefit is increased by about 24% compared to full retirement age. So the difference between claiming at 62 and claiming at 70 is roughly 76%. If your benefit at 62 would be $1,500 per month, your benefit at 70 would be about $2,640 per month. That is an extra $13,680 per year for the rest of your life. Adjusted for inflation, the traditional wisdom is that you should wait to claim if you expect to live a long time, and claim early if you have health problems or need the money. This is basically correct, but it undersells how valuable the delayed claiming strategy can be. Social Security is essentially an inflation-adjusted annuity backed by the full faith and credit of the United States government. There is no private market equivalent. You cannot buy an annuity from an insurance company that provides the same combination of inflation protection, longevity protection, and credit quality at anywhere near the price that Social Security provides. For most people over 55 with significant savings, the optimal strategy is to delay claiming Social Security as long as possible, up to age 70, and use their savings to bridge the gap. Yes, you give up 8 years of benefits between 62 and 70, but in exchange you get a much higher benefit for the rest of your life. Let me give you the numbers. If your benefit at 62 is $18,000 per year and your benefit at 70 is $31,680 per year, you give up $144,000 by waiting. But if you live to 85, you collect an extra $206,000 in higher benefits. If you live to 90, you collect an extra $374,000. The longer you live, the better this decision looks. And here is the key insight: you do not know how long you will live. But Social Security provides insurance against living a very long time. If you die at 72, you lose money by delaying. But if you live to 95, delaying was the best financial decision you ever made. Since you do not know which scenario will occur, it makes sense to optimize for the scenario where you need the most money, which is living a very long time. This is why I would use the Liquidity Fortress and Income Foundation to fund early retirement, delaying Social Security as long as possible. You are essentially buying longevity insurance at a very attractive price. Let me also discuss the role of real estate in wealth preservation money. People over 55 have significant equity in their homes. This equity represents a substantial portion of their net worth, but it is also highly illiquid and concentrated in a single asset. I have mixed feelings about home equity as a wealth preservation tool. On one hand, a paid-off home provides housing security. You cannot be evicted. Your housing costs are limited to property taxes, insurance, and maintenance. In an inflationary environment, owning your home protects you from rising rents. On the other hand, home equity is not liquid. You cannot easily spend it without selling the home or taking out a reverse mortgage, both of which have significant costs and complexities. Home values can decline, as anyone who owned property in 2008 discovered, and a home requires ongoing maintenance and can have unexpected expenses that strain your other resources. My general view is that a paid-off home is a valuable asset for retirees, but you should not count home equity as part of your investable wealth. Your layered defense portfolio should be built from liquid financial assets. The home is a separate thing entirely, providing housing security but not financial flexibility. If you are over 55 and still have a mortgage, I would prioritize paying it off before retirement. The guaranteed return of eliminating mortgage interest, which might be 6 or 7% in today's environment, is highly attractive compared to the uncertain returns of investing those same dollars. And the psychological benefit of owning your home free and clear is substantial. Some financial advisors disagree with this. They argue that mortgage debt at low rates should be kept indefinitely while investing the money instead. This might be mathematically optimal in some scenarios, but it ignores the psychological dimension. Debt is stress. Eliminating debt is peace of mind. And peace of mind has real value that does not show up in spreadsheets. Let me talk about one more topic that I think is critical, which is the role of family in wealth preservation. When you are over 55, your financial decisions affect not just you but your spouse, your children, and potentially your grandchildren. This creates both opportunities and risks. The opportunity is that family can provide support, assistance, and resources that reduce your need for financial reserves. If you know your children would help you in a crisis, you might feel comfortable holding less in your liquidity fortress. If you have family who could provide housing or care if needed, your healthcare risk is reduced. But the risk is that family can also be a source of financial drain. Adult children who need help, grandchildren whose education you want to fund, family members who pressure you for loans or gifts. In-laws who have expectations, the dynamics can be complicated and emotionally charged. I have seen too many retirees whose carefully built wealth was depleted by family obligations. They co-signed loans that went bad. They bailed out children from bad decisions. They funded grandchildren's education at the expense of their own security. They loaned money that was never repaid. This is not to say you should never help family, but you need to be clear about your own financial security first. You need to understand how much you can afford to give without jeopardizing your own retirement. And you need to have the courage to say no when family requests exceed what you can safely provide. The airplane analogy applies here. Put on your own oxygen mask before helping others. If you deplete your wealth helping family, you become a burden on that same family. The best gift you can give your children is not early inheritance, but the knowledge that you will never be financially dependent on them. I would also encourage clear communication about money within families. Your spouse should understand your complete financial picture. Your adult children should have a general sense of your situation, though not necessarily every detail. Everyone should know where the important documents are and who to contact if something happens to you. Too many families avoid talking about money until a crisis forces the conversation. By then, emotions are high, information is incomplete, and bad decisions get made. Have the conversations now, while everyone is healthy and thinking clearly. Let me close with a thought about what wealth preservation really means at a deeper level. When I talk about preserving wealth, I am not just talking about numbers on a statement. I am talking about preserving your options, preserving your independence, preserving your ability to make choices about how you spend your time and who you spend it with, preserving your dignity and self-respect in your final years. Money is not the goal. Money is the tool that enables the goal. And the goal is a life well lived, surrounded by people you love, doing things that matter to you, free from financial anxiety and dependence. The layered defense strategy I have described is designed to protect not just your money but your life. It is designed to ensure that market crashes and inflation and healthcare costs and living longer than expected do not force you into choices you do not want to make. It is designed to give you control over your destiny in an uncertain world. If you are over 55 and you have worked hard and saved diligently, you deserve that control. You deserve security. You deserve peace of mind. Build your layered defense, protect what you have built, and then go live your life knowing that your financial foundation is solid. That is what wealth preservation really means, not just keeping the numbers on your statement from going down, but ensuring that no matter what happens in the economy, in the markets, in your health, or in the world, you will be okay. You have earned that security, now go claim it.